In the previous video, we ran a large optimization to discover potential strategy combinations. From hundreds of configurations, we selected the top 3 strategies. Today, we are going to backtest them to see if they actually hold up in real market conditions. From the optimization results, 3 strategies stood out. Past 25, past 23, past 12. Optimization results alone are not enough. A strategy may look good in optimization, but fail in real testing. That's why the next step is validation. We want to see whether these strategies remain stable under backtesting. Now let's go back to the optimization results and select past 25, which was one of the top performing configurations. To verify the result, we will run a fresh backtest using exactly the same parameters. First, we load the Expert Advisor Zentage ZB Direct Buffet Booster. The symbol we are testing is XAUUSD using the 15-minute time frame. The backtest period is set from January 2024 to April 2026, and the initial deposit is $100,000. For modeling quality, we are using every tick, which provides the most accurate simulation for strategy testing. Next, we restore the parameter set from past 25, including the trigger configuration and filter layer selected during optimization. For risk management, the system applies a risk amount model per trade, allowing position size to scale with the strategy logic. We also enable the Profit Booster module, running in exponential mode, which allows profits to compound progressively as the equity grows. Once everything is configured, we are ready to start the backtest. Now let's take a closer look at the equity curve of this strategy. From the backtest results, we can see a relatively smooth and consistent upward trajectory. The equity curve gradually increases over time without any extreme spikes. This usually indicates that the profit is distributed across many trades rather than relying on a few lucky wins. Another important observation is the drawdown behavior. Although there are several periods of consolidation, particularly around mid-2025 and late 2025, the strategy does not experience deep drawdowns. Instead, the equity curve tends to recover relatively quickly after each pullback. This suggests that the risk control of the strategy is relatively stable. We can also observe that the growth slope slightly accelerates toward the later part of the test period. This may indicate that the strategy performs well under different market volatility regimes. Overall, the equity curve shows a stable upward progression with controlled drawdowns, which is generally a positive sign when evaluating the robustness of a trading strategy. However, it's important to remember that backtest results alone are not sufficient. Now let's take a closer look at the detailed backtest statistics of this strategy. The test starts with an initial deposit of $100,000, and over the entire testing period, the strategy generated a total net profit of approximately $980,000. This means the equity curve almost increased by nearly 10 times the initial capital during the testing period. Next, let's look at the profit factor. The profit factor is around 1.82, which means the strategy generates about $1.82 of profit for every dollar lost. In systematic trading, a profit factor above 1.5 is generally considered acceptable, and above 1.8 usually indicates a reasonably strong edge. Another important metric is the Sharpe ratio, which in this test is around 2.6. This suggests that the strategy maintains a relatively good risk-adjusted return. The total number of trades is about 1,746 trades. This is actually quite important because it provides a sufficiently large sample size for evaluating the strategy's statistical behavior. The win rate is approximately 56%. This indicates that the strategy does not rely on an extremely high win rate, but rather balances win rate and reward to risk characteristics. However, we should also pay attention to the drawdown. The maximum equity drawdown is slightly above 50%. While the strategy eventually recovers and continues to grow, this level of drawdown indicates that risk management and position sizing would be critical if this strategy were deployed in real trading. Another interesting metric is the recovery factor, which is about 17.7. This suggests that despite experiencing drawdowns, the strategy is able to recover and continue generating profits over time. Overall, the backtest statistics indicate that the strategy demonstrates a positive edge with a relatively stable equity curve and a reasonably large number of trades. However, a single backtest result is never sufficient to validate a trading strategy. Now let's move to the next step of the evaluation. In the previous test, the strategy was running with a fixed risk configuration, meaning the position size remained relatively stable throughout the backtest. In this test, we will enable the compound engine. This allows the strategy to gradually increase position size as the account equity grows. Compounding can accelerate capital growth, but it can also increase drawdown risk. So the goal here is to compare the results with the previous test and see which configuration provides the most robust and stable performance. Now let's take a look at the equity curve after enabling the compound engine. And honestly, this result is absolutely crazy. We started this backtest with an initial deposit of $100,000, but by the end of the test, the equity reached more than $30 million. Yes, from 100,000 to over 30 million. That is roughly a 300 times growth during the testing period. Now if we look at the equity curve, we can clearly see how the compound effect works. In the early stage of the test, the curve is almost flat. This is because the account size is still relatively small, so position sizes remain modest. But as the account begins to grow, the compounding engine starts to accelerate the capital growth. Once the account crosses the $1 million level, the growth becomes exponential. And near the end of the backtest, the equity curve almost turns parabolic. This is the true power of risk compounding in algorithmic trading systems. But of course, whenever we see results like this, the next question is always the most important one. Is this growth robust and sustainable, or is it simply the result of aggressive risk scaling? So in the next step, we will carefully analyze the drawdown, the risk profile, and compare it with the fixed risk configuration to understand how stable this strategy really is. Now let's look at the actual performance metrics behind this equity curve. The system started with an initial deposit of $100,000. By the end of the backtest, the strategy generated a total net profit of more than $30 million. That means the capital grew by roughly 300 times during the testing period. What makes this result interesting is that the strategy is not relying on unrealistic win rates. The win rate is only about 53%, which is fairly normal for systematic strategies. Instead, the performance comes from consistent statistical edge combined with capital compounding. The profit factor is around 1.7, showing that the strategy maintains a solid edge over a large number of trades. And speaking of sample size, the system executed over 1,400 trades in this test. This provides a much more reliable dataset compared to strategies that only take a few dozen trades. However, we also need to acknowledge the risk profile. The maximum equity drawdown reaches approximately 53%, which reflects the aggressive nature of compounding. This is why the equity curve begins to accelerate dramatically in the later stages of the test. As the account grows larger, position sizes increase, and profits start expanding exponentially. So what we are seeing here is a classic example of compound growth in algorithmic trading. To keep the video concise, we won't repeat the full backtesting setup process for the remaining configurations. However, we will clearly present the backtest results for Pass 23 and Pass 12 and compare their performance in detail. Now let's take a look at the backtest result for Pass 23. This configuration uses Trigger Mode 1 with Filter Mode 1 as identified during the optimization phase. Starting from an initial deposit of $100,000, the strategy generated a total net profit of approximately $740,000. This brings the final equity to around $840,000, representing a more than 7 times growth over the testing period. What stands out here is the consistency of the equity curve. The growth is relatively smooth, with no extreme spikes, suggesting that the strategy maintains a stable statistical edge over time. Looking at the performance metrics, the profit factor is above 2, which indicates a strong relationship between gross profit and gross loss. The Sharpe ratio is around 3.3, suggesting very strong risk-adjusted performance. The system executed over 1,000 trades, which provides a solid sample size for evaluating the reliability of the strategy. Another interesting observation is the win rate of approximately 61%, showing that the strategy achieves its edge through both accuracy and trade management. Of course, there is still risk involved. The maximum equity drawdown reaches around 40%, which is not trivial, but still within the typical range for systematic trend or momentum strategies. Overall, Pass 23 demonstrates a balanced profile between growth, stability, and statistical robustness. Now let's look at Pass 23 with compounding enabled. Using the same trigger and filter configuration, the strategy now applies exponential position scaling. Starting from $100,000, the system generated more than $19 million in profit. This clearly shows how compounding can dramatically amplify a profitable trading system. Now let's take a look at the result for Pass 12 without compounding. Using the same Trigger 1 and Filter 1 configuration, the strategy delivers a steady and consistent equity curve. Starting from an initial deposit of $100,000, the system generates approximately $780,000 in profit, bringing the account to around $800,000. The equity curve shows gradual growth with controlled pullbacks, indicating a stable trading behavior. Looking at the metrics, the profit factor is around 2 and the Sharpe ratio is above 3, suggesting strong risk-adjusted performance. The strategy also executes over 1,000 trades, which provides a solid statistical foundation. Overall, this configuration demonstrates a balanced profile between growth and stability, making it a strong baseline before introducing compounding. Now let's look at Pass 12. Using the same Trigger 1 and Filter 1 configuration, the strategy again shows strong growth. Starting from $100,000, the backtest produces over $19 million in profit, demonstrating the powerful impact of compounding. Now, after reviewing all 6 configurations, both with and without compounding, we can start to see a clear pattern. Without compounding, all 3 strategies demonstrate a consistent upward equity curve, which confirms that the underlying trading logic has a real statistical edge. However, once compounding is introduced, the performance becomes exponential. But it's important to understand that compounding does not create an edge, it only amplifies the existing one. Among the three configurations, Pass 23 stands out as the most balanced and robust strategy. It delivers strong performance without compounding and maintains stability even when capital scaling is applied. Pass 25, on the other hand, shows the highest growth potential, reaching extreme levels under compounding, but also carries the highest level of risk. Pass 12 sits in between, offering a reasonable balance without clearly outperforming the others. So ultimately, the choice depends on the objective. If the goal is maximum growth, Pass 25 may be preferred. If the goal is stability and robustness, Pass 23 appears to be the strongest candidate.